If you own a business, how you organize that business can save you thousands in taxes. Let's talk about a few options. First of all, it's important to realize that you're normally dealing with two different governments, the state government and the federal government. So the first thing you do when you start a business or reorganize a business is figure out which state entity you want to use to operate that business with. For example, an LLC or corporation. Some states offer a PLLC or a PC, professional limited liability company or professional corporation. And of course, there are other options. Those vary by state. So first choice, which state entity should we set up? Second choice is how should that state entity be taxed? The first choice, which state entity you should set up, should really be a conversation between you and your attorney because there are legal ramifications with varying state entities. How it should be taxed is what this video is going to focus on. So let's talk about a few options. First of all, let's say you consult with your attorney and decide to set up an LLC. And let's say there are two owners of that LLC. In fact, for purposes of this example, we'll say the LLC is a dental practice. And there's two owners, Dr. Jones and Dr. Ramirez. So the two owners form a 50-50 LLC. So the default, if you form a state LLC, is on the federal level, on the IRS level, that LLC will be taxed as a partnership. So option number one up here is going to be an LLC taxed as a partnership. So an LLC for state purposes and a partnership for federal or IRS purposes. Let's talk about what that would look like. So we have an LLC, and we're going to call this the Ramirez Jones LLC. And like I said, Dr. Ramirez and Dr. Jones are both dentists, and they're 50-50 owners of this LLC. Well, let's suppose that Dr. Ramirez and Dr. Jones pay themselves based on production. And let's suppose that their production differs. And let's say in the first year of running this dental practice, Dr. Ramirez is paid $300,000 of compensation, and Dr. Jones is paid $200,000 of compensation. So there's $500,000 of total profit to be distributed out to the owners. Like I said, Ramirez gets $300 and Jones gets $200. With a partnership, that income will flow through to their 1040s. So we have over here, Ramirez, his 1040 gets, like I said, $300,000 of income. And over here, Dr. Jones's 1040 gets $200,000 of income. And this income that passes through to them from the partnership gets taxed at their own individual tax rates. But what sometimes is lesser known, obviously they're going to pay income taxes on this money, but they're also going to pay what we sometimes call self-employment tax. Now, self-employment tax, sometimes referred to as SE tax, is basically Medicare tax and Social Security tax for a self-employed business owner. So SE tax equals Social Security tax plus Medicare tax. Now, Social Security and Medicare tax up to a certain limit is about 15%, 15.3% to be exact. Now that's only up to the Social Security wage base. So the $300,000 and $200,000 are beyond the current Social Security wage base. But nonetheless, it's important to realize that both Dr. Ramirez and Dr. Jones, in this case, if their LLC is taxed as a partnership, would incur both income taxes. They would have income tax and self-employment tax. Income tax plus SE tax for both of them. So that could be a lot of taxes to pay on $500,000, income taxes plus self-employment tax. Now, a very common way to avoid at least some self-employment tax, some Social Security and Medicare tax, is to file an S-Corporation election with the IRS. Now, if we did that, we would still have an LLC, but it would no longer be taxed as a partnership. The LLC would be taxed as an S-Corporation, sometimes referred to as an S-Corp. So if we have an LLC taxed as an S-Corporation, we don't need to dissolve the company and start a new company. This is literally like a two-page form that you file with the IRS. So we file that with the IRS. We say, hey, starting year 2, we're going to tax the same LLC, same bank accounts, same contracts with the insurance companies. We're going to tax it differently with the federal government. We're going to tax it as an S-Corporation. What would happen if we did that? It's still called Ramirez-Jones LLC. And let's say Dr. Ramirez still earns $300,000 during the second year, and Dr. Jones still earns $200,000 during the second year. But it's taxed a little differently. It wouldn't be entirely subject to self-employment tax. It would still be subject to income tax, but some of that self-employment tax could be avoided. And here's how they would do it. So Dr. Ramirez and Dr. Jones would take their income, the $500,000 of income that this LLC earns, is going to be actually put into two different buckets. First bucket is the wage that's paid to each of the owners. That wage is still subject to Social Security and Medicare taxes. The second bucket is the profit distributions that are paid to these two owners. That is not subject to Social Security and Medicare taxes. So the problem here is they have uneven salaries. So let's talk about how this would work. If the wage is subject to Social Security and Medicare taxes, but the profit distributions are not, obviously, Dr. Ramirez and Dr. Jones want to pay themselves a very low wage because that's the one that carries the Social Security and Medicare taxes with it. So how low can they go? Well, there's a lot of case law and IRS regulations surrounding this issue, but in short, they have to pay themselves a reasonable wage. It could be low, but it has to be reasonable based on several factors, based on their experience, based on what other people make in their profession, based on how large their profit distributions are. There's a lot of factors that go into this. So you really want to talk to your CPA about what a reasonable wage would be. Let's say in this case, because Dr. Ramirez is a little more experienced than Dr. Jones, let's say a reasonable wage for Dr. Ramirez would be $150,000. And let's say a reasonable wage for Dr. Jones would be $100,000. Let's say he's very new in the profession. So we have a wage of $150,000 for Dr. Ramirez and a wage of $100,000 for Dr. Jones. So if these wages were paid out, that's $250,000 of the profit of the company that's being paid out in wages. What happens to the other $250,000? Well, the problem is if you're taxed as an S corporation, that profit, that extra $250,000 of profit above and beyond the wages has to be split proportionate to your ownership in the LLC. Like I mentioned, Dr. Ramirez and Dr. Jones have a 50-50 ownership in this LLC. So that $250,000 of profit distributions has to be split $125,000 to Dr. Ramirez and $125,000 to Dr. Jones. So if we did that, Dr. Ramirez has a wage of $150,000 and he would have profit distributions, we'll just call it here profits on the board, of $125,000. That's half, of course, of the $250,000. So $125K of profit. And then, of course, Dr. Jones would also have profit of $125K. What is the problem there? Well, the problem is they intended to pay Dr. Ramirez $300 and Dr. Jones $200 under their compensation agreement based on their production. But what they ended up doing is they paid Dr. Ramirez a wage of $150,000, profit of $125,000. That gives him $275K. And Dr. Jones, they gave $100 and $125, so that gives him $225K. So once they taxed themselves as an S corporation, all of a sudden that affected the actual compensation they received. Well, you can't change the fact that the profit distributions are 50-50, but you can change the wage. So if Dr. Ramirez and Dr. Jones really want to pay themselves $300,000 to Ramirez and $200,000 to Jones, they're going to have to change this wage. In fact, in this case, they could increase Dr. Ramirez's salary so he's paid a wage of $200,000. If he's paid $200,000 and Dr. Jones is paid $100,000, notice now the profit remaining after that wage is $200,000, which would then be split 50-50. So what would that look like? Dr. Ramirez is paid a $200,000 wage, receives profit distributions of $100,000, and Dr. Jones receives a wage of $100,000 and profit distributions of $100,000. So Dr. Ramirez, his total compensation under this would be $300,000, which was what they were originally hoping to pay him. And Dr. Jones would receive $200,000, which again was the original plan, to pay Dr. Jones $200,000. So as you can see, when you make an S-Corp election, you can reduce your salary. You could take less than the $300 and the $200 as salary in order to reduce your self-employment tax, your Social Security taxes. But that could also throw off the math between you and your partner, or you and your partners, if you have a compensation agreement in place. So there's a way to get around that, and that is option number 3. In fact, I should have put 2 up here, because option 1 is an LLC taxed as a partnership. Option 2 is an LLC taxed as an S corporation. Option 3 is a little fancier. It helps us get around the complexity that we just talked about, and there's also another tax advantage of it, and that is to form more than one company. We're going to call option 3 a partnership of S corporations. So how does that work? Let's take away all of this here. And let's get a little fancier. Let's say we have a partnership that is called Ramirez Jones. Ramirez Jones LLC is taxed as a partnership. So let's make that clear. This is taxed as a partnership. And there are 2 owners of Ramirez Jones LLC. There is Ramirez LLC and Jones LLC. So Ramirez Jones LLC is a partnership of Ramirez LLC and Jones LLC. Whereas this is taxed as a partnership, each of these owner LLCs is taxed as an S corporation. So we make an S corporation election for Ramirez LLC and an S corporation election for Jones LLC. Okay, how would that give us any advantages? Well, first of all, let's talk about how that could help with the previous complexities we talked about when the S-Corp election was first made. Partnerships are very flexible. They do not have to distribute out profits exactly in proportion to ownership like S corporations do. So this partnership could give $300,000 of profit distributions. In fact, let's write that up here. They can give $300,000 of profit to Ramirez LLC and $200,000 of profit to Jones LLC. It can be different. Even though they're 50-50 owners in the partnership, they could do what we call special allocations of profit. Okay, so now Ramirez takes his $300,000, then he's going to pay himself a wage out of that $300,000. And the wage he pays himself has to just be reasonable, like I said. So like we said before, a reasonable wage for Dr. Ramirez, we mentioned before, was $150,000. And a reasonable wage for Dr. Jones was $100,000. Now, before it didn't work to pay Ramirez $150,000 and Jones $100,000. Remember how we had to increase Dr. Ramirez up to $200,000 in order to make their total compensation $300,000 and $200,000? Well, with this situation, it does work. Dr. Ramirez still gets the $300,000. He could pay himself a wage of $150,000, whereas Dr. Jones can get the $200,000 and pay a wage of $100,000. So there's just more flexibility with this partnership of S corporations. There's also more tax savings. If you notice, before we had to pay Dr. Ramirez a $200,000 wage in order to honor their compensation agreement. Now we could pay him a lower wage and save more on Social Security and Medicare taxes. So that's one advantage of this partnership of S corporations, is there's just a little bit more flexibility with compensation agreements. And by the way, a little tangent here. You do need to be careful with paying owners solely based on production, but that's probably a topic for another video. For now, we're just saying $300,000, $200,000 based on production. Okay, So advantage number 2 of this structure, besides just having more flexibility, well, really advantage number 3, advantage 1, more flexibility. Advantage 2, even more savings on Social Security and Medicare taxes because, of course, a lower salary was able to be achieved. And advantage number 3 goes way beyond the scope of this video, but it's something that you'll want to just keep in mind. I'll just write it over to the side here. It's something called a 754 election. So let me just give you the basics behind a 754 election. If this partnership makes a 754 election, and a new partner buys in to the partnership, let's say another partner comes in, let's say Dr. Anderson, so Anderson LLC joins this partnership, buys into this partnership. If a 754 election is in place, Dr. Anderson can get some tax advantages from her buy-in. Normally, if Dr. Anderson buys into this LLC and she just buys LLC membership units, you can't really depreciate membership units. You can't really get any tax advantages from buying LLC membership units, but you can if you have a 754 election in place. So that would allow Dr. Anderson to get a significant tax write-off from her buy-in. Let's say she buys into this partnership for $500,000. She can get a significant tax write-off from that $500,000 buy-in if a 754 election is in place. So obviously there's a lot of complexities with everything we talked about today, and definitely consult with your CPA about these things. But it's just good to know that there's a lot of options when it comes to entity structure with running a business.